Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, welcome back, everybody, to Big Money Real Estate. I'm your host, Elise Kling. So a couple of weeks ago, I did a video about the new changes afoot in the mortgage lending industry. TILA-RESPA, or TRID, depending on whatever you prefer, is shaking up the way mortgage lenders will do business after October 3rd of this year. That's thanks to the Consumer Financial Protection Bureau, which has issued these new disclosure guidelines as a part of its mandate under the Dodd-Frank Act. Now, the changes are intended to help protect the end consumer, right, any borrower who obtains a mortgage loan. But for the mortgage lending industry, and by association, the entire community of real estate professionals, the changes are creating a huge amount of anxiety. Lenders are scrambling to make the necessary adjustments before the paperwork requirements change. Realtors are unsure of where they should be. Real estate attorneys, not the ones who represent the lender, but the ones who are representing consumers, are all up in arms. And then you've got everybody else, closing agents and title agents, and everybody's got huge amounts of concern as to how this is actually going to practice. Today I've asked Bill Gilmartin on the show. He's from the National Association of Realtors. And I'm hoping that we can talk about some of the things he's hearing from real estate professionals who are actually prepping for the TILA-RESPA changes right now. He's a senior policy advisor at the National Association of Realtors. He's joining me today from their DC offices. Bill, welcome to Big Money Real Estate.
Well, thank you very much, Elise. Good to be with you.
It's good to have you on the show. So a couple of weeks ago, we did this Twitter chat with the National Association of Realtors. I don't think you were on that. But we also were with Wells Fargo, one of the biggest mortgage lenders in the country, and they've been working feverishly to try and get their lenders, the technology and everything up to speed, and they've been working on it over the last 18 months or so. You've just written another letter to the CFPB asking for, is it an additional grace period of 3 months beyond October 3rd?
Yes, Elise, as a part of our official comment letter, in response to CFPB's proposal to extend the implementation date for TRID to October 3rd, we also went on and explained that we continue to believe that there should be an official grace period, if you will, or relaxed enforcement to extend at least through the end of this year. Many of our industry partners have chimed in with similar proposals, similar requests of CFPB, and others have actually asked that the official grace period extend through the end of March of next year. But we think we're heartened by the fact that unprompted, almost, the Bureau several weeks ago did indicate that in the early going of TRID implementation, they would be, quote, sensitive to good faith efforts to implement the regulations appropriately. And as I said, we're heartened by that, but we'd like a little more specificity in terms of what that means and in terms of what time period that they're considering.
So the TILA-RESPA changes come from the Real Estate Settlement Procedures Act. That's the RESPA part of this. TILA is Truth in Lending Act. So what they're trying to do is actually, and these are the first major changes in, I think, 30 years, right, Bill?
Yes, that's correct. And you very correctly point out that it's TILA and RESPA. And over the years, those two important consumer protections, Truth in Lending Act and the Real Estate Settlements Procedure Act, were administered by different departments in the federal government. TILA was under the Federal Reserve, and RESPA was under the Department of Housing and Urban Development. And right there was the prescription for confusion and overlapping requirements, and generally not the most educating feature for consumers. And over the years, there was many calls for the Fed and HUD to get together and combine those regulations, but it wasn't until the Dodd-Frank Act was passed that the new Consumer Financial Protection Bureau was given that specific mission, and that's what they've done with the TILA-RESPA Integrated Disclosure Rule.
All right, so, which is, of course, where the TRID part of it comes from. Right. So let's talk a little bit about how the realtors play in. And by realtors, of course, we mean any real estate agent or broker, whether or not they're a member of the National Association of Realtors. They are also required to do some things under these new rules. So lenders have all bunches of new disclosures. They're supposed to mail or email, but most of them are probably going to mail it, to consumers the new disclosures on the costs and the money and where it's all going in and out of a week in advance. They're going to be sending this by mail 7 days in advance. Assume that you get it, or they have to email it out 3 days in advance, and then they have to know that you've actually opened it and looked at it. So there's all kinds of technology that's going in there. Where do the realtors come into play, and what are some of the concerns that they and you have?
Well, you're right. The time periods for offering the initial loan estimate and then the final closing document can be confusing, and all the way to the fact that you count Saturdays differently for both documents.
Well, of course, it's just your half day, right?
Well, that's right. But so that's immediately of a concern to realtors in their role of advising clients and home buyers and sellers for that matter. But they'd like to see a process run smoothly. And so the concerns are at different points. The first one being, what will these rules mean for pre-approvals? And because, as you know, the loan estimate must be offered within 3 days of a loan application being filed. And what triggers an official loan application? There are 6 elements of information from the consumer: name, income, social security number, the property address that they are hoping to buy, the estimated value of that, and the amount of the mortgage they're seeking. And once a lender has those 6 pieces of information, they have an application, and they must provide a loan estimate within 3 days. So what does that do to pre-approvals? Very fortunately, CFPB has come out with some unofficial guidance anyways that indicates that as long as you don't have all 6 pieces of information, you can go ahead and seek, the lender can go ahead and seek verifying documentation as far as income, and that can lead to a pre-approval. And so the obvious thing to leave out of the litany of 6 pieces of information is the property address, the subject property that you're hoping to buy. And that may be a workaround, but it's not 100% comfortable for professionals, but that's what we have at the moment in terms of pre-approvals.
So it strikes me, if I could just jump in, it strikes me that one of the things that realtors are most concerned about is the very big possibility that loans simply are not going to close and house deals are not going to close. And you could imagine very easily that a closing set for the morning, let's say it's a sale and a buy, the sale doesn't happen. So now the sellers who were hoping to sell don't have money to buy, so their buy gets canceled. The buyers, the ones that they're buying from, those sellers now can't close on their buy. Those sellers can't close on their buy, and so on and so on. And you could easily see in a single day, 200 deals would fall apart. Is that kind of one of the big concerns? And then if you start another grace period of 3 days or 7 days if they mail everything all over again, and yet companies have already come in, cleaned out the house, people have to find a place to live. Is this sort of the real estate again that you guys are imagining could happen?
Well, yes, indeed, Elise, and thank you for raising that. I was saving kind of the worst for last, if you will.
Oh, I always go first in.
Okay. But sure, delay in closings is a major concern for real estate professionals and members of NAR. But again, we've been working along with trade groups to try to get after the CFPB for official guidance in this arena. And I'm happy to say that they have, in fact, indicated those areas where there are 3 areas, according to the director of CFPB, Richard Cordray, only 3 areas that the rules would demand a new 3-day waiting period. And that is when there's a rate increase of 1/8% for fixed rate mortgages and 1/4% or more for adjustable rate mortgages, or when you change the loan product at the last minute, or if a prepayment penalty is added. According to CFPB, only those three circumstances would require a 3-day period. Now, that's good news, but as you suggest, what happens with the walkthrough on closing day or other typical matters that come up that affect closings? In an ideal world, those matters would be handled just as they are now. But, and there's a big but, and we continue to be concerned how lenders may react, especially when they have investors in a loan. Are they going to pull back and go back to their investors to seek further approval? Will these typical closing day issues lead to new 3-day extensions? We'll have to wait and see how this gets implemented in the field.
Well,
I think lenders are not inclined to want to do that
right.
any more than realtors are, but it's something we're going to have to see how it plays out. It also would be good, as we said in our comment letter, for CFPB to offer just as much possible written guidance as they can to address these kinds of issues.
So I think you've raised some points that I know real estate attorneys are very concerned about, which is when you actually get to the table, so much last-minute negotiating goes on, right? You've got people who are assuming that, the last walkthrough, there's a whole bunch of damage caused by the moving trucks, right? So now they want money up front for that. Or you've got, we're going to give you a carpet allowance. We're going to give you this whole package as part of the closing. Very concerned that the lenders at the last minute, because they're worried about the CFPB coming in and saying, no, that's a totally different loan, that they may have to send that back to underwriting. Or, as you say, one of the things that would send it back is if you've got a document that has just the wrong amount on the loan. So, and I've had that done myself. I went into a loan one day, we were refinancing, it was 1/4 of a point wrong. They instead of redoing the loan, they decided to give us a $200 credit or $250 credit, and we went forward. But that loan was wrong, and it was more than the 1/8 of a percent. So there are some real concerns of things that happen at the very last minute. Even you can only be so planned out when it comes to a house closing. What, is there anything else that the realtors are concerned about in terms of process? I know that some consumer activists are saying, well, if you're sending all these documents out ahead of time, it's possible that the realtor who's going to be part of this chain will see my information, my personal financial information, and I don't want that. Are you concerned about realtors inadvertently getting access to private financial data that they really shouldn't be a party to?
Well, I think realtors, for the most part, are accustomed to seeing the HUD-1, which is an important tool, but under current rules is usually delivered just a day or so before closing, even the day of closing. But it's an important tool to help advise their clients. Realtors have a trained eye and can look at these documents and maybe raise an issue that the consumer might not see. Actually, the concern is that under the new rules, lenders will not be offering a copy of the closing disclosure to realtors. And that realtors may have to simply ask the consumer if they can have a copy in order to help advise them, as they move toward closing. So it's kind of a two-edged sword, if you will. The new closing disclosure really doesn't have any financial information on it that the HUD-1 doesn't. And so we're talking with our industry trade partners in the mortgage banking arena about, and with CFPB about how that issue can be handled.
Are you concerned at all about the realtors' part in this? Like, where do you see points of pain for realtors as opposed to, I can see where the lenders have a point of pain, title closing officers and attorneys, but where for the realtors do you see the point of pain?
Well, I think the main point of pain will be in delayed closings and in trying to help consumers through what for all of us is often a difficult and sometimes overwhelming process. And And so realtors want to help their clients and want to see home purchases and transactions handled as smoothly as possible. And so anytime there's a change like this, and this is a monumental change, there will be concerns about it. I happen to think that NAR and our industry trade partners are doing an excellent job in educating practitioners in the field, and NAR has been hard at work at it for over the past year, conducting a series of webinars. We've populated an entire web page and developed a field guide for realtors to navigate the new paths of TRID. There are a series of articles on our webpage. We've hosted events at our mid-year convention, some of the most well-attended events in recent time, when our National President Chris Polychron and CFPB Director Richard Cordray addressed audiences to educate them about the upcoming changes. And we're going to continue to do that as we move forward and into the implementation phase.
All right. Well, Bill, thank you so much for being with us today. I appreciate it.
Well, thank you, Elise, and thanks for your reporting on this, and thanks for your help.
Oh, no problem. One thing I want to see are people buy houses, sell houses, and have it all go smoothly. Bill Gilmartin is the Senior Policy Advisor for Industry Relations and Outreach for the National Association of Realtors. Bill, I hope you'll come back again soon.
I'd love to. Thank you.
All right. And thank you for watching this episode of Big Money Real Estate. As always, you can send me your real estate investing questions on Twitter and Facebook, and please share this video all around, especially with your real estate agents. Don't forget to check out my brand new series, The Intentional Investor: How to Be Wildly Successful in Real Estate. Until next time, I'm Elise Glink.